Did you know that over $13 trillion is invested in index funds and ETFs combined? That's more than the entire GDP of China. Passive investing isn't just popular, it's a financial revolution. Today we're diving into two investment powerhouses, index funds and ETFs. Both promise diversification and lower costs, but how they work can impact your financial journey in unexpected ways. Even seasoned investors sometimes mix up index funds and ETFs. Why? Because they're similar. Both aim to mirror the performance of a market index like the S&P 500. However, the way you buy them, manage them, and the fees you pay differ significantly. These differences matter. If you're planning to invest your hard-earned money for retirement, wealth building, or just growing savings, knowing which option fits your life is crucial. Let's break it down. First, structure. Both index funds and ETFs are built around a pool of assets designed to mimic an index. Think of them as a giant basket of stocks. The key difference: index funds are mutual funds, while ETFs, exchange-traded funds, trade like stocks on an exchange. Next, trading. Want to buy an index fund? You place an order, and it gets processed at the end of the trading day at the closing price. With ETFs, you can buy or sell anytime the market is open, just like Apple or Tesla stock. This flexibility is great, but it can lead to chasing price swings if you're not careful. Finally, costs. ETFs often have lower expense ratios, meaning you pay less yearly for management fees. Plus, many brokers now offer commission-free ETF trading. Index funds may come with slightly higher minimum investments, like $1,000 or more. But companies like Vanguard and Fidelity are lowering those minimums or even offering $0 options for certain funds. The biggest game changer? Flexibility. If you prefer to invest with a set-it-and-forget-it approach, like automatically investing a part of your paycheck, index funds are perfect. If you want to trade instantly, adjust your portfolio mid-day, or use tactics like stop-loss orders, ETFs provide that edge. Example, let's say you're investing in the Vanguard S&P 500 Index Fund. If it's an index fund like VFIX, you can only buy or sell at the day's closing price. If it's an ETF like VOO, you can trade it at any time during market hours. That difference may seem small, but over years of investing, especially in volatile markets, it can greatly impact your returns and stress levels. So remember, index funds and ETFs both offer low-cost ways to invest passively. However, if you crave flexibility and real-time control, ETFs may be your choice. If you prefer simplicity and autopilot investing, index funds are solid. If you've ever used index funds or ETFs in your portfolio, you know the power of passive investing. Stick around to explore how you can build your first $100,000 with simple strategies. It's closer than you think.